Hello and welcome back to Geopolitics Worldwide. Mexico, the 13th largest country globally and the second largest economy in Latin America, is often underestimated by its northern neighbor, the United States. However, its proximity to the U.S. has become a significant strategic advantage, driving its economic growth. The two countries share a 1,954-mile border, 54 border crossings, and 4 time zones, fostering a robust trade relationship that benefits both, particularly Mexico. A map of Mexico's GDP per capita reveals that economic activity is heavily concentrated in the northern regions, which share a border with the U.S. These states have developed a strong export base and are less reliant on commodities compared to the southern regions. However, this economic dynamism is spreading throughout the country. In 2023, significant growth was observed in the southern states like Oaxaca and Tabasco, driven by a phenomenon known as nearshoring. This practice involves relocating business operations to nearby countries, with Mexico becoming an attractive destination for American, European, and Asian companies. As a result, foreign investment in Mexico surged in 2023, marking a record year with 18% growth. The growing tensions between the U.S. and China, along with trade wars and tariffs, have made manufacturing in China less appealing, leading many companies to shift operations to Mexico. In February 2024, Mexico surpassed China as the leading source of U.S. imports, further fueling its economic growth. This has positioned Mexico as one of the fastest-growing economies in G20 in 2023, with a record wage growth. However, Mexico still faces challenges such as significant income inequality, with a small percentage of the population holding most of the wealth. Approximately 1 in 3 people in Mexico live in poverty, an improvement from 43% in 2016, but still high for a country trying to develop status. Mexico is also known for illicit industries, particularly drug cartels, which contribute to high crime rates and hinder economic growth. This has led to a large informal sector. However, this focus here is on why Mexico is advancing towards becoming a developed nation. Historically, Mexico's economy has been driven by resource extraction. The discovery of large oil fields in the early 20th century, particularly the Cerro Azul field in 1916, positioned Mexico as a leading oil producer. This generated significant revenue, especially during periods of high oil prices. However, the government nationalized the oil industry in 1938, creating Pemex, the state-owned oil company. Pemex's revenue have historically contributed to 30 to 40% of total fiscal revenues. Mexico's economy experienced a period of rapid growth between the 50s and 81, known as the Mexican Economic Miracle. During this time, real GDP grew by 6.5% annually, and the government invested heavily in healthcare, education, and infrastructure. However, the discovery of new oil fields in 1977 led to the overexpansion of public spending, resulting in a debt crisis in 1982 when oil prices dropped. This triggered a decade of economic stagnation, high inflation, and low growth, known as the Lost Decade. Although oil remains crucial to Mexico's economy, accounting for 20% of the revenues, the government has sought to diversify its economic base. Since the 1990s, trade has played a significant role in the effort. In 1994, Mexico joined the North American Free Trade Agreement, or NAFTA, allowing for free trade with the U.S. and Canada. This has led to a boom in exports, which now account for 41% of Mexico's GDP, up from 20% in 1994. The value of exports quadrupled, reaching $465 billion in 2021. Mexico has also diversified its exports, shifting from agricultural goods and oil to labor-intensive manufactured goods like electronics and auto parts. The trade surplus generated by NAFTA helped reduce government debt and accumulated foreign exchange reserves. Additionally, NAFTA stimulated foreign direct investment, or FDI, particularly in the manufacturing sector, creating new jobs and encouraging workers to seek higher education and vocational training. The nearshoring trend is not limited to American companies. European and Chinese firms are also investing in Mexico. In 2023, much of the investment came from companies already operating in Mexico, indicating that nearshoring is still in its early stages. The USMCA agreement, which replaced NAFTA, further incentivizes production in North America by acquiring a certain percentage of goods, such as 75% of automobiles, to be made in the region for quality for tariff-free status. This has led to a rise in assembly plants in Mexico, further boosting the economy. Despite the optimism surrounding Mexico's economy, several challenges remain. Between 1980 and 2019, Mexico's real GDP per capita grew by only 0.7% annually, far below the growth rates of comparable countries like Chile and South Korea. This slow growth is largely due to low productivity gains, which have remained stagnant since the 1980s. Mexico's economic growth has been driven by an expanding labor force, But this demographic advantage also is expected to end by 2030 as the fertility rate declines. Education is another area where Mexico lagged behind. The country has one of the lowest rates of educational attainment and enrollment among OECD countries, which hinders productivity growth. Improving education outcomes could address structural challenges such as inequality in access and quality between urban and rural areas. Another major issue is Mexico's large informal sector, which comprises mainly small businesses that are not taxed or regulated. This sector accounts for 24% of GDP and 55% of unemployment. Workers in the informal economy lack benefits like healthcare and pensions, and informal firms struggle to access credit, limiting their growth potential and reducing government tax revenue. One of the critical challenges hindering Mexico's economic growth is the limited access to credit for the private sector. Despite various banking reforms aimed at improving financial inclusion and accessibility, domestic credit to the private sector remains strikingly low, averaging only around 24% of GDP. This figure is substantially lower compared to other emerging markets like Chile, Brazil, and South Korea, where the rates are significantly higher. This disparity points to a critical structural issue within Mexico's financial system. Access to credit is essential for capital formation, which is a key driver of economic growth. Capital formation involves the accumulation of physical assets such as machinery, buildings, and infrastructure, which are necessary for increasing the productivity capacity for the economy. When businesses, particularly small and medium-sized enterprises, struggle to access credit, they are unable to invest in these assets, limiting their ability to expand, innovate, and create jobs. This, in turn, hampers overall economic growth and productivity. The reason for the low level of credit penetration in Mexico are multifaceted. One significant factor is the high level of informality in the economy. The informal sector, which comprises businesses that are not officially registered and are therefore not subject to taxation or regulation, accounts for a substantial portion of Mexico's economic activity. Informal businesses often lack the necessary documentation and credit to qualify for loans from financial institutions. Additionally, the high cost of credit, coupled with the stringent collateral requirements, makes borrowing unaffordable for many businesses, particularly in the SME sector. Moreover, Mexico's banking sector is highly concentrated, with a few large banks dominating the market. This concentration limits competition, which can lead to higher interest rates and less incentive for banks to extend credit to riskier or smaller enterprises. The limited access to credit not only stifles innovation and entrepreneurship, but also exacerbates income inequality, as wealthier individuals and large corporations with established credit histories are more likely to secure loans. Addressing the credit constraint is crucial for Mexico's economic development. The government and financial institutions need to implement more inclusive banking reforms that target informal sectors and SMEs. This could include creating alternative credit scoring mechanisms that don't rely solely on traditional credit history. Additionally, fostering greater competition within the banking sectors could help reduce the cost of credit and make it more accessible to a broader range of businesses. Despite the challenges, Mexico's demographic profile and strategic position in global trade offer significant opportunities for future growth. Mexico has a relatively young and growing population, with a median age of around 29 years. This contrasts sharply with aging populations in many developed countries, particularly in Europe and East Asia, where shrinking workforces and rising welfare costs are becoming significant economic burdens. A young population provides Mexico with a demographic dividend, characterized by a large working-age population relative to dependents, children, and elderly. This can lead to increased productivity, higher savings rates, and greater economic growth, provided that the workforce is adequately educated and employed in productive sectors. To fully capitalize on this demographic advantage, Mexico must invest in education and vocational training to ensure its workforce is equipped with the skills needed in a rapidly changing global economy. Mexico's strategic position in global trade is another key asset. As global trade patterns shift away from China due to rising labor costs, geopolitical tension, and the configuration of supply chains, Mexico stands to benefit from nearshoring trends. This country's proximity to the U.S., combined with its relatively low labor costs and established industrial base, make it an attractive destination for companies looking to relocate their manufacturing operations closer to the U.S. market. The nearshoring trend is already having a positive impact on Mexico's economy, with increased foreign investment and job creation in key sectors such as automotive, electronics, and logistics. However, to maximize the benefits of nearshoring, Mexico must address its infrastructure challenges, streamline regulatory processes, and improve the overall business environment. This includes reducing bureaucratic red tape, combating corruption, and enhancing the rule of law to create a more predictable and transparent environment for investors.